All right, everybody, welcome to the session here. It's 2023, new year. It's the best time to really get your things together, get your priorities as a trader in line with where you want to be. So, with that in mind, in about 5 or 6 minutes, we are going to start with Chief Market Strategist Matt Maley. He's a Chief Market Strategist at Miller Tabak. Prior to that, he was in Merrill Lynch, Director of Trading in Solomon Brothers, 40-year background in Wall Street. So he has a live room that is correct. A lot of you guys here that I see are members. What's going up? We got Casey, Becky's in the house, David Wong, what's up? Homer, JC, Tinkerbell. Welcome to the house, Tinkerbell. We got Steven Seroy, Series 5. All right, we're going to start in a few minutes, guys, but just wanted to let y'all know we will be talking about option trades. We will show you Matt Maley's 40-year bulletproof strategy. Recession-proof, inflation-proof, Fed-proof, anything-proof. 40 years in the game will get you that, right? So Matt Maley, he's seen a bunch of recessions, crashes. He's lived through all that stuff, right? Some of you guys already have seen him on CNBC or Bloomberg or all these other news, Yahoo Finance, he's all over the place. His education will show you his strategy and the mindset, the walkthrough mentally of what he's thinking before he's making these trades, okay? This is particularly short-term options trading, or what we like to call here volatility trading, considering the markets are very volatile in these markets, right? I mean, specifically this past year, you've seen it. So make sure you're ready, pen and paper. We're going to be talking about a lot of things here, education as well, market discussions, Fed, inflation, rates, everything. So make sure you're paying attention, folks. We'll be back here in about 5 minutes, and we will get this thing started. All right, folks. So welcome here to the session. My name's Rodrigo. I'm going to be here with you and with Matt Maley, Chief Market Strategist at Miller Tabak. He's been doing this for 40 years. Burleson, no, not in Detroit, but I can tell you Detroit is really cold right now. We have a lot planned today, folks. Trade ideas, options education. We will show you Matt Maley's strategy, 40-year bulletproof, inflation-proof, recession-proof, everything-proof, something that you need to add to your arsenal. 22 is especially for those members that are in the chat room with Matt. So I believe we do have Matt in the background. So let's go ahead and bring him on. I'm being told he's out there in the back. Let's go, Matt.
Damn, son, where'd you find this?
All right, let's go ahead and bring on Matt. I think I see him there in the back. All right, Matt, you're good to go?
Can you see me okay?
Yes, everything's good, man. How's everything been there in the chat room? I know you had a wild week there, right?
Yeah, I had some real nice plays already today. I mean, we started off slow because we didn't want to get, we didn't want to force the issue on Tuesday. Obviously the market was closed on Monday. But we some nice trades here, right off the bat, and bought some TQQQ puts late yesterday, sold them this morning for just over 100% return, held on to them, actually added to them at the end of the day. So they're still, in other words, we bought them back, they went down, we bought them back, they went back up, added a little bit more at the end of the day, and did some active trades in Apple Computer. We did some active trades in Tesla, and in both directions. In other words, so we were able to take advantage of the big sell-offs in those names, plus some of the short-term bounces, which is what we want to do here. I mean, we have the tools now as individual traders that we didn't have 10 years ago, or even 5 years ago. They existed 5 years ago, but they weren't liquid. And so we've been able to take advantage of it to kick off the year in a good, solid way. And it's only 3 days old, but it's going to be a lot more solid as we go into the new year, much like it was last year when everybody else was down 20% or more. We were up very nicely, making the right plays, seeing the bear market coming, and trading in an active way to take advantage of it.
Right, Matt. And before we do get started here, in the chat, we have a couple hundred people here. Just want to ask, if this is your first time in one of these sessions, put a 1 in the chat. If you've been here before, put a 2 in the chat. We got 160, 200 people here. So the more people kind of let us know here, the better we know where to drive this conversation, right? We're going to be here for about an hour or so with Matt. As you know, we have to thank Matt for, giving us his time here. He's always busy as a chief market strategist. Time is what you don't have, right? So, all right, Matt. So it looks like several 2s. The ones 1.5, Hugar. I mean, so okay, we got a lot of 1s. Guys, the more we get on this, the better. Trust me, because we'll kind of get a sense of this. But don't be
He's okay.
shy. This is your first time. If you're new, this is probably the best place that you could be. But with trading, finding a community is the most important thing. That's number 1. From there, you'll get a whole bunch of different, follow-throughs from that. So, okay, the ones that are coming in, Matt, they were just a little bit shy. So we have a lot of people that are watching for the first time here. Matt, can you give us a brief overview of your background so that for the folks that are watching for the first time, they can get a sense really of your experience that you have here in the markets?
Yeah, as you mentioned earlier, I'm the chief market strategist at Miller Tabak, in which I've been doing for about 15 years. But before that, unlike most strategists who were former stock analysts and former economists, and those people do a fine job, and many of them do a good job, but they tend to deal on the theoretical side of things. What should happen? What should happen a year from now? What should happen 3 to 5 years from now? But I was a trader. I worked at Salomon Brothers for 15 years. For those of you who have read Liar's Poker, one of the definitive, probably the definitive book on the trading, the great trading era of the 80s and 90s, 1980s and 1990s. That was when trading really became a big deal. Of course, it's been even more so since then. But I was there for 15 years in the 80s and into the 90s for when Solomon Brothers was the most powerful trading desk on Wall Street by far. I say by far, but us and Goldman, we were number one. They were number one in other areas, and still remain a great firm. And then I moved to Merrill Lynch, where I spent 10 years on their trading desk. And again, we're trading, covering the institutional business and covering the biggest, in fact, the very biggest mutual fund, the very biggest hedge fund, and also big banks, insurance companies, et cetera. And you learn yes, believe me, we spent a lot of time trying to figure out what should happen 6 months down the road, or a month down the road, or 3 years down the road. But as a trader, you have to learn quickly on what is going to happen and what is happening right now, because if you don't do that, you just lose too much money too quickly. And no matter what the theoretical stuff is, you have to take other things into consideration besides just the fundamentals. You have to take in a technical analysis. As I've said many, many times in the past, every single really successful hedge fund manager that you can name, it uses technical analysis extensively. I'm not saying they use it fully. I mean that they use it only by any stretch of the imagination. It is a tool, and they use it extensively. I mean, it's funny when you read some of these books on these guys. Stanley Druckenmiller, Paul Tudor Jones, etc. They all use technical analysis in a big way. And so I use that. You use sentiment. You use positioning. All these different things you combine together to figure out what's really going to happen. Because the biggest thing on Wall Street, the biggest farce on Wall Street, is that the market is always right. The market is only always right eventually. Okay. And was the market right at the end of 2021? Of course not. It was way overvalued and dead wrong. So we can go on and on for examples of that. But my point is that the theoretical stuff is all fine and dandy. And don't get me wrong, the fundamental aspects of the marketplace are still very important, and we use them all the time. But we have to use these other factors when you want to use, again, you have that long-term bucket of money where you're thinking, if you're a younger person, you're thinking 40 years down the road. For a little bit older person, maybe it's 10 years down the road, or even just 5 years down the road. But it's also, if you have the time and inclination to use another bucket, and maybe a smaller bucket, but it's one where you can trade more actively. This is the type of things, if you start using that theoretical stuff, you're going to get hammered, because we've seen time and time again where stocks get way overbought and way extended to the upside, or way oversold to the downside. And we like to come in, even though the story is still great, the stock's not going higher for a little while, and you do not want to be buying for short-term trades. Just the opposite. If something goes down a lot, which just happened last week, Tesla, we came in, Tesla was down, I was getting the crap kicked out of it. Everybody heard about it every single day after day after day. Finally, we came in the chat room and said, this is the time to buy the calls. And some of the people were saying, wait, geez, the news is all negative. I'm like, exactly. It's all negative. There is not one good thing out there. Too many people on one side of the boat. We looked at what's called the relative strength index, and we'll go into that later. But some of these charts, it was the most oversold the stock had ever been. This stock has seen some huge swings, as we all know, over the last 10 years. But this one was by far, it wasn't even close, the most oversold it had ever been.
Right.
We went in, we picked up the call options, made 300% in just I think it was a day and a half.
You made the call live while we were here.
I'm sorry?
You made the call when we were doing one of these sessions, actually, and there were several people that reached out the day after, like, hey, man, I just want to let you know that call from Matt. And some people even took the trade the day after, right? So I think that's a great example, Matt, for everybody watching or new traders, that you can make money in down markets, you can make money in up markets, you can play both sides, right? But the goal here really, what I think is great, is that you show traders that they can be on bias to the markets. You don't have to be a perma bull, perma bear. Some of these places. Yeah. So, all right. So maybe Matt, we can go ahead and show them some of the trades that you made with the Matt Maley strategy. Maybe you can share your screen, and for about 30 minutes after that, because a lot of people are asking us in the chat, can you show us some of these trades? Can you show us other examples of your strategy? Yeah. So let's go over that for about 30 minutes. After that, here on the schedule, after 30 minutes, we're going to talk about markets. We're going to talk about different industries.
Perfect. Rodrigo, you've kind of frozen up there a couple
different types of things, guys. So just for everybody to know, can you hear me?
Yeah, so you froze up a couple of times on me here. So I'm sorry if I'm interrupting you. I didn't mean to.
No, you're good. You're good. I was just saying that let's a lot of people are asking if they want to see more examples of your trades, of your strategy. So maybe you can share your screen and we can show them that. After the 30 minutes, we can move on and talk a little bit about the markets, about the Fed, things that you and I have been following through all these years. Well, yeah, 2 years now I've been following your stuff here.
Perfect. Let me just get to some of these things and we'll show you. Stocks you need. Whoops. Did I do this correctly? Hold on. There we go. Okay. Well, let me blow it up here so you can see it a little bit better. Here is the trade I was talking about that we did yesterday. Now, I must admit, I already owned some of these options, but they were the key thing to note first is that we do when we give an example of what we're doing. I don't say, hey, you know something, the QQQ, which is the Nasdaq 100, the ETF on the Nasdaq 100. Hey, this thing looks heavy. We ought to buy some puts, or you ought to look to buy some puts. And that's it. No, we don't do that. I come in and say the exact trade. In this case, we went for the TQQQ because they're the leveraged ETF on the QQQ. And why not try to get a little bit more leverage when we're confident about a trade? So we came in and we bought the TQQQ January $17 put option. We bought this late in the day. I put it at 3 o'clock. It was actually a little after 3. So some of these, I don't want to misguide you, but it was over 100% that we made. And you can see it just, if I put down 102%, who cares if it's 101? I mean, in other words, we doubled our money. So this morning we came in and took profits on some of them. We didn't sell them all because I'm still bearish on the market on a near-term basis, but we want to take some profits. You double your money. Let's face it. If you put down $100, right, and you own this, several puts or any option, you own several puts, and your money doubles, it goes to $200. Great. You sell half, so now you've got your $100 back. Everything else from now on is gravy. It's a great strategy to use, and that's what we used. We held on to it for a while, then the market came back down, and later in the day when the market was down, we added to those puts, and they ran back up, and they're not back to where they were this morning, but the point was that they're still up, and we sold them, so we were able to buy more because we sold half here, then we bought more here, so now we're sitting at the same levels we started yesterday at, but we own more of the puts. But my point is that just today we made 100% on that. Now, the other one, what we were talking about, I'm just going to change here real quickly, change my page, excuse me. I'm going to go to my, oops, what happened here? Sorry. There we go. I'm going to go to my Bloomberg page. And here we are. I want to talk about what we did with Tesla. What have you done for me lately? Well, these have been trades we've done very, very recently. Here we go. Apple. Side, bang. Okay. Here is, okay, I'm going to put it up to, let's see here. Bang. 28th, was it? I'm going to go 1/2/28, 2022. Sorry about that. Okay, this is what we were looking at last week. Let's go 27. This is the chart. This is Tesla. As we saw, it just stocks getting absolutely creamed. These lines up here, I'll get rid of them, but those are some moving averages, the 50, 100, and 200-day moving average. I'll leave the 200-day moving average up there. That's the purple line. But you can see that the stock was just getting absolutely hammered. We all know, what happened with Twitter. Musk was spending too much time looking at Twitter, et cetera. Stock is down 45% in less than a month. 45%, okay, in less than 4 weeks. And there was nothing but bad news out on it. So I came in, I said, look at this stock. The most oversold it had ever been. It's got down to 16. And I said, okay, we got to come in here and buy the calls. Okay. And sure enough, the stock, and of course, let me update it. As you know, I'm sure you saw 01/05/23. So you can see that it bounced back here. Okay, it bounced back here, and you say, well, geez, that's just a tiny little blurb on the radar screen. But when you're buying options that only expire a day or two away, we bought these last week, and the stock goes, that's a 15% move in the stock. Okay, we were in there buying the calls. We were able to make over 300. Some people made over 300%. I made over 301. I made just under 300, but it's about 300 on the total trade, because a lot of times I'll scale in. I'll show you some examples of that too, where we'll buy some options, and then when if the thing doubles, we'll sell half and then let the rest ride. We can make a lot more money and letting them ride. That's worked out very well for us in the past. So now we're looking at a situation here where this stock could go anywhere tomorrow. We'll talk about that later and what we're looking for over the near term. But this stock, we even suggested maybe buying some straddles. We don't go too much in this. We don't get too much doing these big iron condors and things like that. Or puts, calls. Once in a while, I'll do a straddle or a strangle, but that's really about it. We try to keep it simple, stupid, and my level of expertise is finding situations at key turning points and taking advantage of it, and that's worked out real well for us. Now I just wanted to go back. Oh, Apple was the other one that we did this week. Okay, I'll go back for a while here. RSI, bang. Here we are with Apple. I want to go back to 2021. 2021, sorry about that. And I get rid of some of these lines. It just gets real busy. The chart looks, ridiculous. I'll leave actually, I'll just get rid of all of them. Bang, bang. Okay, and you can see how the stock, went down and made its June lows. When it got to 150, I'm going to put this up again. Sorry about that. Let me just do it real quickly. What's going on here? Hey. Okay, sorry about that. Equity. What the heck is going on? Okay, great. Sorry about that. A little mix up with my screen. Okay, now, as you can see how the 150 level, it kept going up. It actually got above it, but it kept bouncing up against it, I'm sorry, take it back. We're going back on here. When it was getting hit in the fall, I said, if this thing gets back below 150, that's going to be a big problem because that was the old high here, the old high, okay, so that old resistance became new support. We broke below it, tried to break back above it a couple of times, actually succeeded for a day or two, but then fell out of bed. So when we failed at 150, we were in there making negative plays on that call. But one thing I was watching very closely is as the thing breaks below 130, I really thought that this was a key support level. That was the lows in June. It was going to be a big problem for the stock. Well, sure enough, it sold off. It sold down to the 127 level. And they say, well, no, just a few days after I said that this stock was going lower and people were buying puts in the stock, I said, okay, this has gone too far. The RSI, the stock, and here, let's take this up. This is literally 2 days ago. Let's go 0.3. And let's blow it up so we can see what's just been happening in recent months. I just said, this was too much. This was getting overdone to the downside. So we came in here and bought the calls. We bought the $130 calls. And again, these things, depending on where you sold them, we sold some that were up 50%. Some people made more than twice their money. But again, when stocks get oversold, I went back to this RSI, Relative Strength Index. Let me go back to the Tesla thing real quickly, and I'll just show you how that works for educational purposes. Okay, the RSI, Relative Strength Index. See how ridiculously oversold it was, the most oversold it ever become, ever. Okay. What we do with these RSI charts, when it gets to 30, it has that green line. That means buy. It means it's getting oversold. Too many, no matter what the fundamentals are, even the fundamentals stink, which they don't stink for Apple, but even if they do, we're going to sell it. We want to buy the stock. Green. That's why it's a green. Buy. Go ahead and buy it. When it gets up to 70, this is red. Stop buying it. Don't buy it anymore. See how it was? You think Apple became a horrible company in early August? No, but it got overbought, okay, and it was still overvalued, and we'll go over that later on. So it kind of traded sideways for a while, but it finally broke down. Boom, 60%. That's Tesla. I'm sorry, that was not Apple. That was Tesla. But either way, it's like, did Tesla really get 60% worse? No, it just because it had gotten ridiculously overbought on a near-term basis and had to come down. There were other issues, of course, with Musk, et cetera. But my point is, and same thing here in Apple, is that you got to be careful about saying, oh, it's a really good company, it's really good management. Boy, about a year and a half ago, I was talking with somebody in the chat room who was all mad at me for saying that for not liking Tesla. And I said, I just don't like the stock at that moment. And this was before it split. The stock was trading above, well above 1,000, I think about 1,200. And I was saying the stock's going to go below 1,000. He thought I was nuts. He said, Musk is the smartest man in the, like, I'm not saying anything about Musk. I'm not saying anything about the company. I'm saying the stock is overbought and it's going to sell off. And it worked out really well, just as it did this past week. But again, we came in Apple, and even though this bounce lasted one day, okay, and we got out of it, okay? So we can make money in these things. Now let's see if I can pull up the options here. It's not always easy because I didn't do the chart like I do at times. But here, let's see if I can go. Bang. Yeah, I can't really do it. Sorry. But this was the one we bought. Let's see if it gives it to us. Boom. No, it can't give it to us. But anyway, you can see that the stock, well, you saw what the stock did. The stock rallied only a couple of percent, but the options rallied for over 100%. I actually still own a couple. I own two. I have two left. I have a tiny piece. I honestly forgot all about them. I was looking at my portfolio today. And I was like, oh, geez, I still own these calls. Believe me, I made way more money than I already made a nice profit on the trade. And in fact, and they're still worth something, but if Apple bounces tomorrow, I'll sell them. If they may expire worthless, doesn't matter. I still made real nice money. And I only own two options in that one. But again, these are the types of trades. But let's go into some better examples, or more, not better examples. Those are good examples. Let's go with some more examples to give you the consistency. Not just, oh, did we happen to get lucky just recently where we got a bunch of good trades, or have we something we've done really well with? I just have a little here because I have so many different examples on this left-hand column here. But I just want to show you some of the ones that we've been able to do. Now, I'll start off with our best trade and walk through what I was thinking. This is our best trade ever, and it worked out extremely well. Those who've seen our webinars before are probably a little tired of seeing this one. But whoops, that wasn't the right one. Okay, let's see here. Let me hit escape. Hold on a second. 60, did I have it the wrong one? 61, bang. Okay, there it is. I'm sorry. Sorry about that. Okay, now, oops, I don't want to go share. I want to go that. There, so you can see it. Okay, FXI. This is the large cap China stock ETF. And this is where a stock, remember we talked about, again, forget about this thing that says last week's chart. It was just, it's, last weekend's chart. That's an old, it's something I printed up in March. But you can see how the stock market and the FXI, the ETF for the Chinese stock market was getting killed in 2021. Stock market in the US was flying, but China was cracking down on all of its industries. It was one a month. They went out to started with Alibaba and the internet industry. Then they went to other technology areas. They went to the educational area. They went to gaming, et cetera, every single month, or at least every 6 weeks. And sure enough, the market would get hit. They'd try to rally back. They'd crack down again. The market would get hit. But they were doing it to themselves. They didn't mind. I'm talking about the government. President Xi was doing this. It's like, but then early last year, about this time last year, in the first quarter, the SEC in the U.S. came in and said, we're thinking about delisting a bunch of your stocks, and the market got crushed. So they look bad. They're losing face because it wasn't them that was knocking it down. It was the U.S. And so look at this RSI chart. It got to 14. That's even more oversold than Tesla was last week. Only the second most oversold I've ever seen anything. Okay. And I said, okay, this is out of control. This is, number one, I've been doing this a long time. I know how it works. China doesn't want to lose face to the US. Number one. Number two, they don't want to let their stock market implode. It was March. And remember, they had they were 6 months away from their big 5-year Congress. They don't want this thing to get out of hand. They're going to come in and support it. So not only is it oversold and due for a bounce on a technical basis, but I know the government's going to come in and buy the stocks with their own money. They're going to, and believe me, they can make sure people don't sell, if you know what I mean. I mean, it's a communist country. And so we went in and we bought some call options that day. And so let me just escape again real quick. Let's see. There we go. So sure enough, the next day, their stock market rallied 27%. That would be like the Dow Jones Industrial Average rallying 27% in one day. Okay, this was actually 2 days, but you can see that the first day the high was basically the same. So it was the same rally. But you can see how this thing took off. Huge rally. What we had done, we had come in on the 15th. Okay, We had the 14th, 15th, 16th, and we didn't, you see, so here down on the 15th, late on the 15th, we bought the FXI, March 18th, $30 calls. So we gave you the exact expiration date, the exact strike price, well, obviously whether it's going to be a call or a put, and of course the asset involved. These things rallied almost 3,000% in the first hour or so. They opened up 1,000%, up 1,000%. So we're making 10 times our money. And people are like, well, why didn't you? Usually, if you make 2 or 3 times your money in one day, when you make a real good call like this, you just get out. It's like I tripled my money and basically in 2 hours of trading and 12 hours of a day. Obviously, the market was closed for overnight, but you sit there and you say, no, just take the profits and go. Well, not in this case, because I knew that the Chinese government would keep buying their market. It was so oversold that it had to rally on its own a lot and stay rallying for a lot. But I knew the Chinese government would do whatever it took to push it all through the day. So we held on for a while. But finally at 10:30, markets open only an hour, but I'm like, we're up 3,000%. I can't get too greedy here. But we didn't sell them all. We sold half. I sold half of my position here and told everybody. And I always tell, when I buy it, when I sell it, I don't tell you 10 minutes later. I don't tell you a half an hour before. I tell you right then. A lot of times I'll say, hey, I'm looking at this. I'm going to buy it at some point today or within the next few days. And then I'll come and say, okay, now I'm going to go ahead and buy it. And again, it was traded on the 15th. We sold it on the 16th. This March 18th date is the expiration date for that option. Okay. And again, we gave you the exact $30 put, so $30 call. Then later in the day, it got to the very end of the day, the market's up almost 8,000%. And I said, okay, this thing's probably going higher, but I'm going to go ahead and sell. Sold the other half. So obviously our average price is over 5,000% gain in one day. And there are people who held on. I can't take credit for the rest of it. People held on who said they made over 10,000. I think over 11,000. One person even said 14,000. I can't vouch for those because they weren't trades that I made, but it certainly theoretically could have happened. And if they did hold on, they almost certainly did make it, at least 10,000%. So these, this is not what something we do all the time, but these are the kind of trades we have done. We did the same thing the previous year in Viacom, which has now been split up into Paramount and some other things, but the stock dropped 60. It was the same thing. Let me see. In fact, I'll see if I pull up the chart here, if I can find it. Yeah, let me pull it up. I'll show you what happened. This was Viacom, and let's see here. There we go. This was Viacom, and this was during the meme stock craze. Okay. And it got ridiculously overbought. And I'm like, look at every time the stock got pretty overbought, actually very overbought here. And the stock went down. Got overbought here, stock went down. Stock down. Overbought here, down, not a lot, but overbought here, down. Look how overbought it was here. I was like, crazy. We got to buy the call options, the put options. Sure enough, we came in, bought the puts, stock dropped 60% the next day, and we made 5,000. But it was the same type of thing. Made 2,500% on half, 5,000% on the other. So, about somewhere around 4,000%, a little less important, 4,000% gain. That was in 2021. So again, this is not something we do every week, every month, but we've had some of these big ones several times in the last 2 years. And, we had another one in the thousands of percent in Amazon. It was one that I didn't even take advantage of. The people in the, let me see if I can find here. Yeah, 80. It was one where other people were saying, hey, Matt, we got this, here it is. Every time Amazon splits, the stock goes up. And I did all the work, and I was like, I had a bunch of other positions. I really like it. You guys should go ahead and do it. I didn't, but they did. And it was their idea anyway. And I wish I had listened to them, because some people sold it up 500%. Others were up more than 1,500%. I think some people even made 2,500%. But these were the things that, again, so it's not just, again, I'm not trying to say every week you're going to come in here and we're going to make 1,000% on all our trades. We'd all retire in 6 months, right? But we do have some big ones. Now let's go to some others just to show you that we do have a consistent play here. And I don't want to bore you to death with some of these things, but I do want to show you some other ones. Boom, 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 boom. And we do it obviously on individual stocks. Oops. It's not my AMD. Here it goes. Advanced Micro Devices. Here was one where we made, this was back in June. The stock was getting oversold. It's funny because when the stock was trading above at 130, people were fighting me when I turned bearish on it. And I was like, no, this stock could trade below 100. And I go, yes, it's a good company, a great CEO, but the stock is way overbought. And since businesses are starting to get a little shaky, well, sure enough, we bought the puts. You can see, we were very specific on the trades we made. We didn't just say any old calls. I'm sorry, take that back. The stock, we had been negative and it had a big drop. But then I said, okay, it's dropped enough. We got to look at this thing. It's getting oversold. And we bought the AMD June 3rd, $105 calls. Sure enough, sold them the next day. We bought them in the morning, let them ride. It was like, oh, geez, this is not looking so good. But I had a lot of confidence in the call. And sure enough, we had a big rally. I didn't sell them right at the top. And, I probably could have sold them for 160% gain. But if you're going to lose, if you make 160% a day and you beat yourself up for not getting 150, 146%, you didn't get 156%, don't do this because you will drive yourself nuts. Do not do this. But it just gives you an idea. This is back in June. Okay. Oops. Just skip again. Okay. Hold on a second here. There we go. Sorry about that. But I'm just going to go through some of these because we get them in the 80s here. There we go. Here's another one. We showed that one. There we go. Here's some SQQQ options. Those are the bearish ETF, the 3 times inverse bearish ETF. Okay. And this one, where we made, sometimes we do TQQQ. This one was the SQQQ. Again, in one day, we made over 400%. And this was, again, in June. This is June 10th. So we're doing some nice trades in June. For crying out loud. Okay. There we go. We went back some QQQ options here. So this was when you don't have as much. This is one where I wish I had done the SQQQ, sorry, the TQQQs, because we went in, I just didn't have as much confidence in this trade. So I went and bought the QQQ ones instead of the leveraged ETFs, but we made 500% in one day. This is when the markets can get really wild. Okay, XLE. Again, we do it sometimes in individual stocks where we showed you we've done it with Tesla, we've done it with Apple Computer, we've done it with Advanced Micro Devices, AMD. Now we have it in the ETFs and in the group sector ETFs, the XLE. This was the XLE June 17th put. I had been wildly bullish on the energy stocks since October, but way earlier than anybody else on Wall Street, October 2020. By early 2021, a lot of the Western Wall Street jumped in and they patted themselves on the back for remaining bullish since then. But something, they missed half the move. That's great. They pat themselves on the back on the one. But I had seen what was going on, that everybody was on one side of the boat. And when I came out bullish on it, they're all going, are you nuts? Clean energy, no chance. And I'm like, that's the problem. Nobody owns energy stocks. Nobody owns oil. In fact, everybody's shorted, everybody's positioned the other way. You're not just going to get a short squeeze, but we also had the fundamental story behind it, et cetera. Turn bullish on that whole group, remain bullish through 2021. Now we're into 2022. I made a couple of small trades here and there on both sides of the thing, but then okay, now listen, this thing has become ridiculously overbought. Everybody's bullish on the thing. It's a year and a half later. I'm going to make another trade. We're actually going to go against my call. I said, don't sell your energy stocks. Hold on to them. They're going to go higher, which they did. But if you want to take a little profits, or if you have some extra cash on hand, let's go in and buy these puts. And we bought the XLE June 17th, $90 puts. Again, we bought them on June 8th and we sold them on June 13th, even though the expiration date was the 17th. But in 3 days, we made 560% because I just knew that they'd become too overbought. So you can see stocks, indexes like the QQQs, the ETFs, et cetera. But we also do it in different markets. We did it in the China stock market, right? But we also do it in commodities. Okay, what happened here? Okay, here we go. Let's say wheat, believe it or not. Now, the old days, this is another thing too. Just to go back on this thing we were talking about, having the tools. In the old days, if you wanted to buy something on wheat, well, you had to go to the, just make sure I got the right one. There it is. You would have to get, call a commodities broker in Chicago, on the Chicago Board of Trade, open a margin account, open an options, a futures account. It's not easy. Okay. Now you just go to the ETFs. No, it's not me spelling wheat incorrectly. That's the symbol, WEAT, is the symbol for wheat, the commodity. And so we use those and we bought the options. I had been wildly bullish on the commodity markets in the first 5 months of 2022. I turned bearish at that time, but then they got ridiculously oversold by July. Sure enough, on July 6th, again, we bought them on July 6th, sold them 2 days later on July 8th. The expiration date was July 15th. But again, it's like, no, we don't have to go out and call somebody we've never heard of, never met in Chicago to set up an account. We just go ahead and use our regular account, use the options on the ETF. We bought the WEAT July 15th, $9 calls, 250% in 2.5 days. So again, these are the types of things. There was another one, LABU, L-A-B-U, which is just, oh, here's one, TLT calls. That's on the bond futures. Whoops. This is on the Treasury bond futures. Again, 230% in just a couple of days. Again, in July. So we showed you some from May, June, July, et cetera. We did a lot of different times. But here, let's driving me crazy here and driving myself crazy. There we go. Bang. LABU. Okay, that is the 3-time leveraged ETF for the IBB for the biotech ETF. There's 2 of them that trade well. I tend to go for the IBBs, but either way, LABU is the 3-time leverage. So we came in here. The group was very, very oversold. Bought the LABU August 5th calls. Bought them on the 3rd, sold them on the 4th. We held them for almost a full 24 hours. Made 800%. These look, and again, they're not all 800% or 2,000, but we have a lot of them. We do them consistently. Here's the okay. Here's some more TQQQ trades. UUP made 100% in September. Again, we're doing them each month. We get, we don't do them every day. Sometimes we don't get a big one in a week. But again, this was the dollar. We thought the dollar got, remember, it was just rallying all year long. It became ridiculously overbought. We bought the September 23rd calls early in the month. I'm sorry, the puts early in the month. Again, the UUP, September 23rd, that's the expiration date, $29, that's the strike price, and the puts. And we bought those. Bought them on the 7th, sold them 4 days later for doubled our money. And again, I'm going to go, here's some QQQ calls in October. Whoops. Here's one where we get, not all of them are huge home runs, okay? 53% on these bond futures. That's still 53% in a couple of days. It's still pretty darn good. Yeah, if I do say so myself. Let's go again. I don't want to, oops, there we go.
Right, and Matt, really quick here, and I'm getting a lot of questions here about the live room here, the trading room. So let me go over these questions here for about a minute or two. Then we can get back here to talking about a couple things about markets, sectors, Fed, a couple things that I have here scheduled out to go over. It's just going to be a quick minute here. So again, by the way, folks, thanks a lot for sending these questions. I just basically picked out the ones that were the most common. We have about 500 people watching here, Matt. So try to take my be really quick with this. 1 second. Okay, let me pull these up. All right, so does Matt Maley go over student trade ideas? Yes. I don't know if Matt was able to go over the specific one that we did in Amazon, but the Amazon trade was very, very well that came out from a chat member. Snapchat, Tiffany shorting Roth and shorting Target. I remember those very well, making thousands of percents of that. And listen, you can't do that on spreads. It's just not how the math works. So that's really why a lot of people here are really attracted to Matt Maley's strategy that he has been practicing and finessing for 40 years. So good questions there, Jeremy. Are the sessions on Tuesdays recorded? Yeah, so we'll talk about that a little bit more now once we follow through from this. But basically, Matt has a chat member private only session. He does that for about 45 minutes, 1 hour. It started as a 10-minute thing, but Matt, he gets all riled up and he'll go for days. So now it's like a 1 hour session, 45-minute session, and it pretty much covers updates on the current markets, of the current trades, current portfolio that Matt is trading, because that is a great portal for you to get really your what you need to know for trading. There's a lot of noise out there. Matt simplifies everything down to basically how to profit from what's going on. So yes, those sessions will be recorded. Chat members do have access to that. Next question here, Phil. What is the chat room schedule? Great question. It's from 8:39 a.m. Eastern till about 5 p.m. Eastern. So you do have 30 minutes before the open, right? And this is when Matt is there, like in the chat room. The chat room is open 24/7. We do have a global community. Matt and I launched this chat room about a year and 3 months ago, something like that. And I signed up people all the way from Zimbabwe to Finland to Canada. There's people from all over the place, and that makes it great. We have a UPS driver too there. We got a lot of people from different backgrounds, all walks of life. So it's really interesting to get, this sort of feedback, this community, right, of dedicated traders that are trying to improve their strategies, their skills, and make real income, not blow up their account chasing meme stocks like, most traders end up doing when they start. So that's really good. Let's see. Price at renewal is going to be the same as today. We will post a link in the chat on Zoom and YouTube. Let's see. Next question. Does Matt provide education? Yes. Every time that Matt discusses trades, he will tell you exactly what he's doing. It's either going to be technical education on technical analysis, on fundamental analysis, on market discussions, on Fed behavior. Okay. Fed behavior is so important, and also what to really expect. This is not Matt Maley's first correction or recession, if you will. He's been around the game for 40 years. It's not his first time. So you do get a lot of education and real education of what's currently happening, not what the economists say will happen, but what's actually happening, right? So good question there. Let's see. Let's carry on here. We got two more here. Do you have push notifications? Yes, we do. We do have push notifications enabled. So if you do download the Benzinga app and you log in with your credentials, once you are signed up, of course, for Matt Maley's live room, you will be receiving the push notifications on every single entry, every single exit, and market commentary that Matt will be posting in the chat room. So you do have that, even, like if you have a full-time job or you're part-time, whatever it is, you do have technology on your side. That's really good to know. And you can also access the chat room literally from anywhere, your phone, your tablet, your iPhone, your computer. As long as you have internet, you'll be able to use this. And how much do these trades go for? So Matt Maley, we're typically buying calls and puts on CQQQ or SQQQ, which are the triple leverage ETFs following the NASDAQ. And Matt Maley will, these contracts will go for about 60, 70 cents to like 90 cents, a dollar. They're not buffed up with premium because they are short term, and they're really meant to catch the volatility. Like Matt was saying, now we do have the resources, right, to the financial vehicles to do this. Before, I believe you could just buy a call and it was like, what, 20 years out, Matt? Something like that.
Yeah, I mean, yeah, they go.
Some ridiculous.
If you wanted to buy a bet on pretty much any stock or any index right now, you would have to go out to March. That's a lot of time premium you're paying. Now you can buy it for an index the next day, and for most stocks, or at least certainly the big and medium stocks, that week. You don't have to pay those huge time premiums. So it's really, really, really great.
Yeah, and obviously for somebody like me that started trading 4 years ago, I have no clue about any of this stuff. And look, the thing is, Matt, when 2020 was here, everybody felt like a Warren Buffett. Everything was going up. We have unlimited maniac QE through the door. And now we are in a totally different environment. What's the last time that we were in this type of environment? Fed, rate-wise, inflation-wise, geopolitical situation-wise, everything.
Well, this is, it reminds me so much of what happened as we're coming out of the tech bubble in 1999, 2000, when it was peaking in 2000. And the reason why I say that is that, a lot of people are saying, hey, this is not 2008. I'm like, I agree, it's not. But that doesn't mean it's not good. I mean, a year ago, all these people were saying, hey, the tech stocks are a little overbought. Excuse me. But they're not, I'm sorry, a little overvalued, but they're not as overvalued as they were in 2000. And I said to a guy on CNBC, I was like, so what? I mean, just because they're not the most overvalued of all time doesn't mean they're not overvalued. They're still very overvalued. And look what's happened to the group. In the same situation we're having now, just because it's not 2008 again, doesn't mean that it's not bad. Now, again, I don't think we're going to have any, we're going to have this situation where the whole financial system starts to worry about that. And we didn't have that in 2000. And in 2000, when the dot-com bubble burst, it was much more because things had gotten ridiculously out of control in terms of valuations. And so when the market came down, yes, we had a recession, but it wasn't a horrible recession. But the market still came down a lot. And we're going to face, I think, a very similar situation then. Now, back then, not to get too much into the weeds, but the market was pushed up in the late 1990s through this artificial liquidity, these artificial steroids. That happened because of Y2K. If people don't know that, it had to do with all the computers were going to go they would go from 98, 99, the year 2000. Well, instead of that 00 being 2000, the computer was going to think it was 1900, and everybody's bank accounts would have disappeared. So they had to spend billions of dollars to fix the computer systems throughout the whole banking system, throughout the whole system of the world. So the whole not even just the financial system, the whole business system. And so the global central banks poured liquidity into the system behind the scenes. And everybody thinks it was a new people thought it was no, it was all because of massive liquidity. Okay, that's what pushed it. It wasn't a new economy. It was massive liquidity coming into the marketplace. Money had nowhere to go. It went into all these tech stocks, pushed them higher. Guess what? When 2000 came along, the double zero came up. They let it go for about a month because to make sure everything was running okay. And then they pulled the plug on all the liquidity. And guess what? You think it was a coincidence? The market rolled over. Okay, it bounced around for a while and then really got hit. But the point is, it topped out, especially the NASDAQ, topped out right a month after 2000. The same thing happened this time around. The global central banks had to pour money into the system to save the system in 2020. In March of 2020, we had a situation where the economy, the global economy, had just stopped. I mean, all but stopped, right? That had never happened before. Okay, so it's like we've got to do something to save the economy because the system was imploding just as badly as it was in 2000 and 2008. Not because the banks were doing stupid things, because there was just nothing going on. Nothing was moving, and so the bond market was freezing up. That's what really caused the Fed to do that. The bond market was freezing up, and if you don't have money markets, treasury markets, commercial paper, that stuff going through the credit markets, the system freezes up. They came in, provided all that liquidity. The problem is, to keep the things going for a while, they had to keep the liquidity going for a year and a half. That pushed the market to all-time highs, just like it did back in 2009. And you cannot unwind that in 1 year. And that's why people say, well, we've had 1 year. No, the stock market is still expensive. The only way the stock market trades at 18 to 22 times earnings is when you have a massive QE program or zero interest rates, these artificial steroids. We're not going to have those, okay? Even if the Fed stops hiking rates, they're going to keep them high. They're not going back down anywhere near zero, okay? Zero interest rates are not, the capital system does not function with zero interest rates. You have to have a spread for these companies and financial institutions to make money, okay? And then they're not going back to QE. So that's the very similar situation that at 18 times, we're going to have to go back to 15 to 16 times earnings, no matter what happens to the economy. That means more volatility in 2023. That means more opportunities for us. And like I said, we finally have the tools to take advantage of.
Right. Well, look, I mean, I think you need to change your name to Mr. Volatility, because that is, something that you have definitely embraced and properly traded accurately. And this is something that it's great because you have entries and exits. And to give everybody here a quick perspective, the real difference here, Matt, between you and some of these guys out there that are on news is that many of these guys are these strategists, which means you're able to find opportunities outside the US, such as that FXI trade there. You've been able to make some insane trades, either shorting or going long on the dollar as well, because you're looking at what's happening all around. You understand the Chinese economy, you understand all these other, you've talked to me about the Japanese yen and some things like that, I mean, you can trade these things. And this is what's cool, because I didn't know even about FXI until you made that trade. And for those that don't know, FXI is the highest, the record, Benzinga record all time since the company started, with the highest percentage gain. It was about an 8,000% win. Some people even said they made over 13, 14 the next day they held. So it has been, and before that, guess who had the record? It was Matt Maley again. So you can't do this with spreads, Matt. It's really great how you've been able to dominate and finesse this particular strategy. So I think it's really good that you're able to help new traders out there that are really, sometimes just trying to get the quick trade or ignore the overall market conditions, because ultimately that only hurts you, right? And we saw that with all the new traders that came in on 2020.
Yeah, and I think if there's anything that I could tell people right now is if you want to be an active trader, even if you are an active trader and you've been doing it for a while, and you've had a certain amount of success or not, the one thing you have to remember, we've all heard about these great hedge fund traders and these guys who've made billions of dollars in some cases, and others who've made hundreds of millions of dollars, or maybe just tens of millions of dollars. Either way, they've done really, really well. Well, guess what? Every single one of them talks to many people every day. Now, you're on a trading desk at a big hedge fund, you've got all sorts of traders that you're talking to. Well, hey, did you hear this news? Hey, did you hear about the downgrade that somebody just downgraded Apple? But not only that, even if it's a smaller hedge fund, you only have 2 or 3 guys all sitting together. They're having brokers call them all day long. They don't have an individual broker. They don't have one stockbroker. Every single stockbroker, Morgan Stanley, Goldman Sachs, Wells Fargo, Citigroup, in smaller firms, Miller Tabak, everybody's calling them left and right, giving them these, making sure that they see, giving them ideas, making sure they hear all the relevant news on the overall market, overall stocks. They have all that information. If the best and smartest hedge fund traders in the world need to be talking to people all day long, how are you going to do it alone? They don't do it alone. You shouldn't do it alone. So it just makes common sense. And the thing about us is that we don't have 10,000 people in here where you get some people who do the pump and dump, where you think that they're you think they claim they're Joe Blow from East Bumfuck wherever, and who what they really are is a hedge fund guy trying to pump up the stock so they can dump their position because they know there's bad news coming out. You don't want to be stuck in that thing. You have people who are helping each other. Like I said, and Rodrigo mentioned, we have all sorts of trades that I had nothing to do with. There are people that they pointed them out, and I would say, yeah, that's a great one. So if you think I'm the only one giving good ideas out there, we're all working together. It's really a great, and then people keeping each other in check. It's like there's been some things somebody will come out and say, hey, look at this, and they'll go through their explanation on their thinking, and then somebody else will say, sometimes frequently me, and say, oh, but you got to be careful about that. Like, oh, I never thought of that. Oh my gosh, I'm not going to buy calls. In fact, I'm going to buy puts. More often than not, it's just that, something I'm going to hold off, or, hey, I'm going to wait a little bit before I make that trade. And it helps people so much more, because in this business, it's half the time it's avoiding making the mistakes. On top of making the good trades, like anything else, you want to be batting way better than a Major League Baseball player, a great player bat 300, 320. We want to be batting 600, 700, 800. But we also want to make sure that the hits we do get are good ones, and the strikeouts are not with the bases loaded. In other words, we don't lose a lot of money. We try to minimize our losses, let our gainers run, and so that those batting, when you're batting 600, 700, 800, you feel like you're batting 2,000.
Right. Trading for tomorrow says you need a community and a good one. Well, look, man, there's nothing worse than trading alone, because it's just, for somebody that's new, imagine trying to teach yourself through law school, which you cannot, give yourself a degree, but then, you really don't have that bounce back, because you really do not have a totally true educated response. Your thoughts just keep coming in, and you're like, let me trade this meme stock, let me go all in, let me buy calls that expire tomorrow, 100 strikes out. And that's because they're saying pump it on StockTwits, on these boards. It's very easy to fall into these traps as new traders. Matt, what do you think would be the number one advice that you would give for all the people here who have under 3 years trading, which are still considered new traders? Advices to really stay away from these beginner mistakes that we tend to make.
Well, it's just, again, it's maybe self-serving here, but you work with a group of people. Look at this. This is Bed Bath and Beyond. Okay, look at this. Well, let's tighten it up. There were people who were thinking they were brilliant when they were buying the stock here at $50. Well, guess what? It's trading at $1.60, and today they said they're basically going to go out of business. Okay, it's down 96%, and just look how much it's down here.
Wasn't that Yeah, that stock had so much drama. Didn't the CFO jump off a building or something?
Yeah, that was that's really sad. But look at this. Since August, the stock's down 90% since August. Okay, forget about what it was way back here in 2001. And why did it? You're trying to tell me their business suddenly got, boom, 400% better from the end of July to the end of August? Of course not. It was ridiculous. And a bunch of guys sold up here, and a bunch of people got suckered into buying it up here. Somebody had to buy it. It wouldn't have gotten there. And then within a couple of days, it was dramatically lower. These are the types of things you want to be able to avoid. And people ask me about it. This thing's really running, and I'm like, yeah, go ahead. If you do it real small, because I just I don't see any reason for it. There was no reason for it. It was just some short squeezing and some pump and dumpers. But the number one thing is, again, work with people who are going to teach you and tell you why. Why am I making this trade? What is the fundamental backdrop behind it? People say, oh, there's a big short interest. Let's buy it. Okay, that did work a couple of times in 2021, but didn't work for very long. And people got their heads handed to them. But we can sit there and go, well, look at this chart. Look at this chart. And look at the fundamental backdrop. This is the least expensive it's been for how many years? Their margins are improving, whatever happens to be. Guess what? Everybody and on top of that, everybody hates the stock and they're short. Okay, now you said, okay, the shortage is really high, so it's poised for a short squeeze. But you've also given me 5 other issues, or maybe it's just 2 other issues why I should be buying the stock. And first of all, it gives you a lot more confidence to be a little bit more aggressive. But if you're just going for guessing, it just doesn't work. So again, it just goes back to the thing: working with a team of people, and you learn you learn very quickly that people are helping each other. Nobody's trying to, there's times to say, heck, I've got to go out. Yesterday, nothing serious at all. But my wife had to go to the doctors, and she couldn't get an eye issue, so she couldn't go and she couldn't get a ride. I said, oh, okay. So I went and got her, took her so I was gone for way long. I thought it'd be like an hour, long for 2 hours. People were talking all day long. It wasn't like I wasn't there, so we can't do anything. They're going back and forth for all the time in those 2 hours and making some nice trades. So
right.
It's a real team effort, and and you'll learn very quickly the people, and you can ask questions. Hey, this might be a dumb question, but there's no, XYZ. There's no such thing as a dumb question. Ask them all the time. I still think people need to do that more often. Don't be afraid.
And not be shy, right?
I've been doing this 40 years. I learn something new every day. I know it's an old saying, but it is absolutely true. And, don't be afraid.
It's human. Also people could be shy, but then the other thing is don't be afraid to communicate and participate. These chat rooms have the best community out there. These are real people. There's no bots, no fake accounts. All these people, I know them individually. Some I met in person. They are great traders and they love to help other traders that's what you're there for. This is a workplace, right? So, Matt, this has been great, man. But let's talk a little bit about the markets here, because I want the folks to really get a sense of your overview. So let's just kind of backtrack a little bit, because this is a new year, but 2022 was kind of nuts. So we kind of unpacked 2022. We went from this will not cause inflation to it will be temporary to there will be no pain, soft landing, to get ready to feel the pain. And so people don't know really where to stand with what's happening with rates, with inflation. You have already lived through this. You've traded through this at these funds that you've been at. So considering 2022, right, and you can kind of unpack from there, where do you see this year, at least this first quarter, right, as far as trading behavior, market behavior, Fed behavior, and how we can profit from that as traders?
Yeah, the thing is that I still see that we got problems here, and I think one of the best things to look at is Microsoft. Now, again, it's something new just happened this week, and in the last 24 hours or last 27 hours, Satya Nadella, who is the CEO. Now, this time, a little bit earlier, Thanksgiving of last year, 2021, so just over a year ago, not this most recent Thanksgiving, Mr. Nadella came out and sold in 2 different lots. One literally Thanksgiving week, and the following was either whether 1 or 2 weeks afterwards. But either way, it was 2 lots, and it was $274 million in one and $100 million in the other. So $374 million, 2/3 of his holdings. And I said at the time in the chat room, I'm saying, this stock, you got to get out of this stock. And I said, and it's a great company. Mr. Nadella is a great CEO, and he did nothing wrong. He announced what he had done, and I said to myself, you don't sell 2/3 of your holdings, that much money, $374 million worth of stock, unless you know the stock is not just going down, but it's going to stay down. Okay. Because he had gone through 20% corrections a gazillion times over the last 10 years, but he never sold any. Well, he might have sold little shares here and there. And also, if a CEO comes out and says, "Hey, I've got $500 million worth of stock, I'm going to sell 15 million," And then after the taxes, I'll have 8 million because I want to buy a house in Hawaii or whatever, 20 million, whatever they want to do. I want to buy a real fancy house in Hawaii. Okay, fine. But you sell $375 million worth of stock. You don't do that. You don't bypass. You don't sit there and say, market's down 10%, 20%, and you just let it out. No, everything's fine. I'm going to keep, he did that for 10 years. This time he said, no, not everything isn't fine. The Fed is about to tighten. My stock is ridiculously expensive. Even though our business is good, it's not as good as the prices. And he sold his stock. Okay. Now he's got more stock at the end of the year in his bonus. He'll get more stock just now with the end of this the next year. So it's building back up again. He did nothing wrong, nothing unethical. Now, believe me, if they had announced an accounting scandal 2 weeks later, he would have gone to jail. But that's not the case. He was not doing anything wrong. He was not the one who was goosing the stock by making false claims about the company. Everything was right above board. He just realized that the stock had gone way above what it was valued, number one. And number two, he realized with the Fed pulling interest rates, pulling on the plug on a stimulus, both taking away zero interest rates and taking away the QE, that his stock was going to go down and stay down for a while. Well, guess what? He was out here. Was it yesterday? I heard it this morning, but I think it was out yesterday. I'm going to give you the exact. Well, I may not be able to find it, but I wrote down the exact quote. But anyway, he was just basically saying he doesn't see how. Same thing as look for 2 more years of headwinds for the technology sector. Okay, again, cloud computing is weak. Remember, even 6 months ago, people were saying, well, the one thing nobody has to worry about is cloud computing because that's never going to go well. It'll be years before that slows. Well, it's slowed down. It's slowed down for Microsoft. It's slowed down for Amazon. People forget Amazon makes most of their money from cloud computing. All these different companies have been talking about what the cloud computing has slowed down. He's in here saying that the most important and most profitable area of the business is slowing considerably. It's going to face headwinds for 2 more years. Okay, this is the guy that saved himself $125 million by selling 2/3 of his personal holdings just over a year ago. I pay attention to what he has to do. Now, again, you want to go for a learning thing. I'm going to get on a tangent here, but it's important to know if there's anything you learn tonight, learn this, especially if you're young. The next time this happens, I might be retired. Because it may not happen. Well, it'll happen sometime in the next 10 years. I'll still be around, but the next several times it happens, I might be retired. But the point is, it happens not all the time. I'm saying happens all the time in a long-term picture. It doesn't happen every year or even every month. But when things get crazy, it happens. And what happens is the insiders sell. And when the insiders sell, the smart ones, you need to pay attention. In 1999, Goldman Sachs had been a private firm for over 100 years. The partners sold their stock through an IPO. In other words, they sold the company through an IPO to the public. Now, they still kept some of the shares for themselves, just like Mr. Nadella kept some of his Microsoft shares, but they sold a big bulk of it to the. When did they do that? 1999. Why? Because they saw what was coming. You don't make that much money over 100 years and then decide to sell all at once. They sold because they said, this market's going down and staying down for a while. Let's cash out. Okay, that's what they did. In 2005, Sam Zell, it was 2006, Sam Zell saw what was going on in the real estate market. He didn't go public. He sold his company to another private company. His was a private company, sold to another private company. This was his life. That was his whole life. He sold what it was his whole life. Who would sell what was their whole life unless he saw what was going on in his business, the commercial real estate business or the real estate business overall? He saw the top. He got out. Blackstone, one of the best private equity firms in the world. What did they do? They had been private for 25 years. What did they do? They one summer they decided, we're going to sell ourselves to the public. They had an IPO, sold themselves to the public. What year was that? Summer of 2007. What happened 3 months later? The stock market topped out and we had the great financial crisis. They saw it coming. They're smart people. When the smart people sell, you get out. I get other examples. I get one other one just real quickly is that at the top of the commodities market in 2011, Glencore was a big private trading company in the commodities area out of Switzerland. Again, they went public, same thing. Literally, it was March of 2011. And in May, the market topped and started an 8-year bear market. This is what happens. Pay attention when the really smart people sell a lot. Now, an IPO doesn't mean that the insiders are selling. And if you're not familiar, IPO is an initial public offering when you first go from a private company and sell it to the public, initial public offering. And just because a company does an initial public offering doesn't mean that the insiders are all selling. Okay, so be careful of that. A lot of most IPOs have nothing to do with that. Sure, the insiders, the guys who founded the company will sell some, but it's not doesn't mean that they're selling. Sometimes they're just like, no, we want to expand more. We need to raise more money, so let we cash in a little bit for ourselves. We'll keep the most of our shares, and we'll sell some to the public, and we'll build 10 more factories, and we'll make a lot more money. That's what they usually do. And in fact, you see Microsoft. They went through their IPO, their initial public offering, in the early 1980s, and that market stock didn't go down. Well, that's because Bill Gates barely sold any shares. He sold $1 million worth of shares, kept the rest of them, and of course the stock went for years and years and years. But my point is, I got off on a tangent there, but I just want to tell you how these are the types of things that we try to talk about when it comes to education within the business. Now, getting back to what's going on now. So he just comes out and says, we're going for 2 more years. So why are you going to back up the truck? And you get some of these people saying, oh, it's a buying opportunity of a lifetime, some of these tech stocks. It's just not. Microsoft is still expensive. Apple is still relatively expensive. It's not overly expensive, but the stock usually trades down. It's about 20 times earnings, 21 times earnings. It usually trades in a bear market down to like 15 times earnings. It's even fallen to 10 times earnings. It's a great company. We're not talking about the company. We're talking about the stock. Okay. So I think that, again, interest rates are going to remain elevated. Pause isn't pivot. And so the tech stocks are going to say are ones I'm going to continue to avoid. Got off on a tangent there. Sorry, Rodrigo, but that's just one of the issues that I'm looking at right now.
No, it's important to cover this stuff, obviously, because when you're like on these other networks, they want you to answer all the problems worlds in 10 seconds. So you do have some time here to really kind of explain the overview. I want to give a shout out here to Sandra and Michael, our newest family members here at the Options and Stock Picks, really. Inner Circle chat room, let's go. And really, folks, what Matt is doing, he's focused on trading options, but that doesn't mean you're not, you cannot ask Matt about stocks, right? Like what are some 3 or 5 long-term stocks that I can hold, really for my child's college fund or whatever it is that you're trying to do. So think outside the box, right? You can ask Matt anything you want. Melissa Rosso, hey, what's up? Happy New Year to you too. Let's see. Let's get a couple of questions here from some of the members. Donald Guntherman, Rodrigo, and Matt, thank you for Benzinga for the little. We're all about helping the average Joe. I'm glad you get it, Donald. That's really what we do here. That's our focus. I'm a trader myself. I use Matt's chat room if I'm not tied up helping you guys or trying to figure out how to make the chat room better. If I have time to trade, trust me, I am in Matt's chat room, and it's really easy to follow. I got push notifications sent to my phone. I don't have to have a chat room open. I literally just get the notification on my phone as I'm working, typing out my emails, answering to all you guys in the middle of calls. So yeah, we have a quick question here from Melissa Rosso. Okay, Matt, what sectors do you like now? Just the typical recession sectors like healthcare and consumer staples. So I guess the question is, what sectors do you like now? The typical ones or anything in particular?
Well, it's funny. I mean, it's yes, to answer your question. But the whole idea is that we want to be able to profit on the way down. So in other words, if you're only holding some of these sectors, you're going to go down. You're just going to go down less. But this past year, as you know, I was pounding the table at this time last year saying, raise cash, get defensive, buy the healthcare, but mostly buy the defensive, but stay in the energy stocks. And of course, they were up 74% when the rest of the market was down. What I'm doing right now is I'm still bullish on the energy stocks. I'm getting a little nervous only because I do, the economy is slowing. But look at what we're doing right now. So the way we're playing it in the XLE, this is the XLE, this is the energy stock ETF. And we're looking, this yellow line, that's the 50-day moving average. And the green line is the 100-day moving average. You can see we're bouncing right between them right now. Okay, that doesn't always happen to be the case. What I'm thinking, I really like the fact that even though it dipped slightly below that 100-day, whenever it breaks slightly below a support level or slightly above a resistance level, it's not a big deal. You got to wait until it gets a little bit more meaningfully, 2 or 3% above it. Here it got a little bit low, but not much. Bounce back, that's bullish. If we can just get it above that 50-day moving average, then we're going to go then it's going to go and retest this double top high. Now we're using the technical analysis. And if you go back here, 2018, you can see it a little bit better. See how it's a double top there. I mean, it's a little bit higher there, but it's double top. You break above that, I'm telling you, it is going to fly like you wouldn't believe. And as mentioned on the fundamental side, as most of them are saying, that a lot of these energy stocks are still trading like oil is trading at $65, not at the. It's like oil can come down into the 70s, and these stocks are still going to be okay.
Right. No, and that's really the beauty, right? Because I don't know if I mentioned this, but within the chat room, okay, within the chat room, folks, with Matt's live room, you're talking about 3 to 5 plus trades a day, adding positions, cutting positions, managing positions, right? Because many times Matt will tell you, all right, guys, we're up 150%. We're going to take half. We're going to let the rest ride. And, remember, we do trade as a team. If you want to lone wolf this and do what 90% of traders do and blow up their accounts, that's fine. But it's just as important, managing the trade, equally as important to opening and closing it, right? Matt is looking at the charts. Matt is looking at the markets. He's been doing this for 40 years. I promise you, he's really qualified for what he's doing here. So if you're new, you've been trading under 4 or 5 years, this is probably a good avenue for you to really get, solid trading recommendations and trade management, right? So yes, you do get the push notifications, but on top of that, you will get 1 to 2 email trade alerts, and these are stocks. So you swing these, right? We're talking buying the stock and selling it at a target price. You will get this by email. These are separate trades from the chat room. So these the way that Matt does it is really to kind of create a type of portfolio, right? So that you're trading options, but you also have a little bit of a swing portfolio included there. So you will get the exact contract price, the exact expiration, the exact stock that Matt is buying. He's not just going to vaguely say, hey, I like Google. He's going to give you an exact contract, call or put, expiration, what he's looking at. And then as he is managing the position, you will get that as well sent to you by the push notifications here. And maybe I can just show this because I keep getting questions about this, but basically, yes. Let me pull this up here 1 second. Just so that you guys can really get a sense. Okay. All right, we'll do that at the end here, but basically, that was a good question there. And as far as like what you get, entry, exit, the exact moment, obviously, if you're talking about a call that expires the same day, it's going to fluctuate. Obviously, it's pretty common sense that like if you buy a call or a put that expires the same day, it can literally change like by the time you hit enter or by the time you do something. That's really why push notifications are king here. And guess what? Like we didn't have the push notifications like a month ago, but it's something that I've been pushing hard for the developers. And I do want to give a big shout out there to Vin, Tammy, Neil, a lot of the people that really helped, have helped, behind the scenes to bring on this technology. So big shout out there to them. And no, we do not have it. Raj, the members will have full access to the recording, but everybody else here can watch free. So Matt, let's get back here into the conversation. You've been following commodities, you've been following housing, real estate. Out of all the sectors right now, is there a particular sector that you feel strongly about? I know you just talked about the XLF, so we can, you can skip that if that's your one, but is there another sector really that you're concerned about, that you're truly feel troubled about?
Well, I mean,
besides crypto.
Yeah, I just say one of the things I'm looking at right now that I'm worried about, again, and I'm not worried, very important, I'm not worried about this because I think we're going to have a repeat of the banking crisis we had a dozen years ago. But I am worried about the bank stocks. They're cheap, that's fine. But and again, I'm not worried about them because I think they're going to fail or anything like that. And in fact, it's going to be very interesting tomorrow when we get the employment report. If interest rates, if it's a number that helps the stock market rally, look at the bank stocks could finally rally a little bit here because we're looking at what's called a MACD chart. Again, it's an educational thing, but you can see when you see. I won't go into it too much here, but when it's kind of like a golden cross. Whenever you see the 12-day moving average cross above the 26-day. That's what signals here. See, when you see a positive cross here on that white line, see how the market's rallied, how that group has rallied. Same thing happened here. Group rallied strongly. See what happened here? Group rallied strongly. It just happened here, and it's rallying strongly. This thing could really run. However, so that's side, but both in short term and intermediate term. Short term, we got to wait to see what the number is tomorrow, because I might go turn negative on this thing on a dime. But I might want to buy some calls in some of these individual names. This is the KBE Bank ETF. The options in this ETF are not very liquid, so I tend to go to the individual stocks. And Bank of America being a lower price stock, even though it's a great company, I like to go for that one because its options are just cheaper or less expensive. Don't cost as much. The difference between cheap and whatever. But the point is, it gets it back up to its 200-day moving average, this purple line, and especially if it gets slightly above it, I'm going to be looking at all the technical indicators to see if it tells us that it's getting overbought, because I'm going to take advantage of it again. So I'm looking to make money on the upside and then again on the downside, first to the upside, then to the downside. But if tomorrow's employment number is market negative, I'm not going to wait for that rally. I'm going to go right to the bearish side. So here's a group that I'm worried about because, and again, I'm not worried about the banking system failing. What I'm worried about is that they just don't make as much money in recessions, and I think we're headed for recession. We've had one soft landing in my lifetime. The chances of having another one when the Fed is tightening to the degree that they are, it's not going to happen. So that's another one that I'm worried about. But overall, for the overall market, I'm just concerned. I just think you need to be high in cash, high in some dividend names for the longer term basis, dividend names that will pay you to wait, especially not just the highest paying dividend names, but the ones that have signs or have records of increasing their dividends every year. And there's plenty of those around. I mean, I'll tell you right now. There's one we were talking about we talk a lot about short term trades. Whether it be trades that expire in a couple of days or in a couple of weeks. This one was a long-term call. Verizon, bang. Okay. This stock broke to a nice higher high. It's rallying nicely. I said, you ought to buy this stock. Well, now it's starting to get a little overbought. You can see here on its RSI, it was way down here, saw a nice rally. Now I'm starting to think this thing could be under some pressure near term. However, I'll bring it back up here. Again, we're trying to talk about a lot of different things so people can learn. But Verizon, it's like it's been a dead stock for a long time. See, it's in dividend yield 6.2%. 6.2%. That's going to pay you to wait. They had one of Leon Cooperman was on today on CNBC after the close, just before we came on here, and he was talking about how he didn't see the stock market going up 10% over the next 2 years, not 10% each year. He said that the chances of it going up 10% over the next 2 years are really low. And so he was saying that he liked the 2-year bill because you'll make about 10% on that. Here you're going to get, for 2 years, you're going to get 12%. Why not own that? The stock will come back. It's Verizon. It's they're not going out of business. So again, these are the types of things that we're talking about at different times. And then, believe me, there was a time a year and a half ago when I was saying you got to sell Verizon with both hands. So it's sorry, I just froze up there. Oops.
Yeah, you were one of the few that were bullish on commodities for years and years. Again, for those that haven't been following, I understand, but me that haven't been following you when you go on your interviews and things like that, all around 2022, you were very consistent, very accurate with your predictions of the SPY levels of what was coming down into the markets, despite the news kept doing what they do. Giving you all these numbers to make you feel that money all the way for the whole year shorting the markets, which is great. That helped me and other traders. If you weren't shorting in 2022, you got smoked, period. Like, that is something that if you have been bullish because you don't want to be a negative person or whatever, if you want to live that way, that's fine, but that has nothing to do with this. We're trading the markets in front of us, right, Matt? And I just think it's great that you help the new traders with that.
And people have to realize that most of people on Wall Street are paid to be bullish. I mean, that's their job. I mean, it's like, how many people who sell Chevrolets think that the Chevrolet is the best car in the world? Well, I mean, people come in to buy a Chevrolet, they want to sell them a Chevrolet. I mean, they say, is a Porsche a better car? Yeah, but that's not what I'm selling. I'm selling Chevrolet. Well, that's what these guys are paid to do. I'm sorry, it is what they do. And now, I'm not saying they're unethical, because the market does usually go up, but you have to be out there and knowing if you can't be a perma bear, you can't be a perma bull either. You've got to be able to help people out when the market's turning down. And like I said before, in the old days, the only ones that could take advantage of these situations were the big institutions, because they're the only ones who had access to these derivative trades. Now we all do, and they're all liquid. We don't have to worry about, geez, I bought that, made a really good bet, but there's no, now I want to sell it. Nobody wants to buy it. I can't make any money. That doesn't work. Now these things are all really liquid. So that's what we're just trying to accomplish here, is help people. We have the tools now, but if people don't know how to use them, it just is much harder. And again, I'm not trying to say I'm a genius or anything like that. I'm just saying I've been doing this a long time, and a lot of this stuff isn't obvious at first. But once you learn them, you learn these rules, and sometimes you sit there and go, it makes no sense whatsoever. But then when you look at it and say, and then you look at the history and you go, oh my gosh, it doesn't make any sense, but it works. And so some of these rules. So but until somebody teaches you, I don't care how smart you are. I mean, you can be the smartest person in the world, but if somebody's never told it to you, what you're going to do is that really smart people, they're going to figure it out, but it's going to cost them a lot of money to figure it out. They're going to take a lot of losses before they finally figure it out. Why do that? Why try to learn a new language, by reading a book, when you can have a tutor help you through it? I guess.
Right. And Matt, even though there's a lot of people, they might want to learn technicals and things like that, even though you do have education, you're not randomly throwing a dart like, okay, let me sell now, let me buy now.
No.
You're looking at charts, deep research analysis, which for those that didn't know, Matt Maley, chief market strategist at Miller Tabak, they basically provide research analysis to institutions where they can make their own investment decisions. You as a retail trader, you get all that. You get all that plus the trade ideas, which I'm telling you, as a retail trader, the fact that you do have a chief market strategist on your corner is already kind of insane that you can start there, right? Compared to following all these gurus on Twitter and TikTok, all that stuff. RAG has an interesting question.
Sure.
What do you think about preferred stocks or closed-end funds?
Yeah, those are fine. I mean, I do not really trade in the preferred stocks. I think they're fine depending on which ones you look at. They're harder to trade. They're in terms of for swing trading and such. Because they have a more of a bond aspect to them, but they do pay some real good dividends and you get your good yield. So they're good to play right now for those those longer term basis. When you're trying to hide some money, to store some money for a little while the market's going through this patch of volatility. So what was the other one? The preferreds and the closed-end funds. Yeah, it's again, you want to look for the best ones, and they use a lot of options anyway. They do a lot of spreads and stuff to maximize their returns. And again, it really is going to depend on which ones you look at. I don't tend to look at them as much as I do individual stocks or ETFs ETFs. Because they're not as good at trading vehicles. They're more of the kind of buy and hold that can be very very profitable, but not so much for the uses that we're using. So I don't really look at them as much as I haven't traded them as over the years, so I don't have as much experience. But again, mostly because they're not real good trading vehicles compared to these other issues.
Right. Yeah. No. There's this. This is probably the crazy. I mean, I don't know. You've definitely seen it. A lot of things, but this market to a recession, to I don't know what to say, an uneducated Fed, because I don't really know if they know what they were doing or if they were just playing along to try to keep their jobs. I don't know, but it's definitely not the time to wing it. I'll tell you that. It's not the time to try to do this alone or figure it out, because it's just not. Yeah, anybody can walk into the markets, right, Matt? People from all walks of life, but a brokerage doesn't care Like you can open an account, put $250,000 and blow it up the next day, and they won't care about you at all. And really, they can make money out of you either way, whatever you do. The difference here, the real difference here, is that we are actively helping individual retail traders, average Joes, to get built up into the markets. Because if you try to wing it, there's 1,000 ways, 1,000,000 ways to lose money. There's fewer ways to really do it correct, right, Matt?
There's no question. Even when you're doing it correct, you're going to have some losses. I mean, you're going to have some losers. It's that every great trader in the world has had losers. And the whole idea, though, is using risk management to limit first of all, keep those number of losses to a minimum, and then when you do have them, to keep limit those losses. But you're gonna have losing trades quite a bit. Like I said, nobody bats 950, nobody bats 900. Few people bat 800. You don't really bat 800. You're gonna have those losers. You just move on. But the point is, okay, I lost a little bit here, and it was a small amount of money. Because a lot of times, what I'll do, I'll go into a trade and say, hey, I'm going to put a little bit here. Okay, now I'm going to add more to that trade. I'm going to add even more. And so I build up the trade, and I've got a winning trade already, and I can put a stop below, and basically guarantee that the worst I do is come out flat, and then just let the thing run. And whereas you start small. Oh, it's not working. Let's get out. Okay, great. I lost 20% on that option, but it was a tiny amount of money. It's not that big a deal. Whereas when I made 20% or I made 20% on the winner, well, it was 7 times the size as the one I just lost 20% on. More importantly, that one we didn't make 20%, we made 120%. And so the whole thing, so the returns, again, it's risk management. It's all too often people don't even look at that and look at some certain strategies. You just try to make sure it's not working, get out, move on to the next one. I mean, I've traded around the TLT. $17, sorry, TLT, the TQQQ, $17 puts. I've been trading around that all week, getting in and out of it, keeping a core position, but selling off half, buying it back at lower level, go back up, selling it out, and adding more than half, and then trading around it. Because you can see, here's the S&P this in the last couple of weeks. See that kind of sideways move. That gives us we're getting a little more active and getting in and out of stuff a little bit quicker. And then once this thing breaks out, well, then we breaks out of this range. Then we'll let some of these positions ride for a couple of days, and I'll add to them. I won't just trade around them all the time. I'll let them go, and that's when you get suddenly I've got a decent sized position, and suddenly you're up 200 or 300%, and that makes up for a lot of small losses where you've lost 10, 20% or 50% on really small. I mean, I've had trades where they were so small I didn't even care. I said, I'm just going to let that expire, worthless. It was a tiny trade, tiny trade. I don't worry about it. And every once in a while, you do a lottery ticket. It's like, geez, I just made a lot of money on a bunch of trades. I'm going to take a tiny percent of that, 1%, and I'm going to take a lottery ticket and take those profits. And I can make 10 times my money. It'll only be on a small amount, but it's okay. And if it goes to zero, it doesn't matter, because instead of making 50% this week, I made 49. Who cares? You might as well, it's okay. You can play those kind of games. But again, it's risk management, rather than just throwing, oh my God, some guy in a chat room with 10,000 people, or some guy on CNBC said buy the stock, and he's got a 10-year a 10-year horizon, and you've got a 2-day horizon, and you lose your shirt. It's just not
right. It's very important to clarify here, right? It's not day trading. We're not day trading options, but sometimes look, if the trade happens the same day and you're up 200%, why not take a little profit? But most of these trades are meant, for like 2-3 day time span or around there, right, Matt? So it's a very short swing. It's not a day trade, but it's not a swing, right?
Once in a while, we'll do them a little bit longer, but very rarely do we go past 2 weeks. I mean, I can't remember a time I went past. I shouldn't say that. I take it back. Once in a while, in some VIX trades, we'll go longer, because that's more like buying insurance, and we'll go out several months. But they're not very expensive, and you can play those. But other than those, we just go out, and we usually got a week and a half, 2 weeks at the most. And although we can hold them to the expire, we usually sell them before they expire. And that's the thing. Some people say, well, geez, I bought those Apple calls. They were the $130 calls. I bought them when the stock was at about 124. I can't remember the numbers now, but the stock never got up to 130. Didn't matter. We got the 128. We made over 100% on the thing because we bought it at the right. We timed it right. It doesn't have to. people sometimes say, well, if you're paying $1 and your strike price is 130, you can't make a profit until it gets to 131. Like, well, no, because if the market really, the stock really starts going up, some of these people are are willing to pay, pay that high immediately. So again, that goes into some of the educational aspects of it, but some of that textbook stuff isn't as tough. It's not as arduous as it might sound when you read the textbook.
Yeah, this is definitely a very different time for sure. And I know that you do cover a lot of stocks. Is there a particular, you talked about a couple sectors. We've talked about the option strategy. We've given real life examples of how you've been able to do this with the chat members. Is there anything in particular, Matt? We have about 30 minutes here. So anything in particular that you do want to cover, or if you kind of want to take it to the audience, what would you like to do for these?
Well, let's go over a couple of things, and then we'll throw it to the audience, and they can ask me give us some tickers where we want to look at. But I was going to say right now, one we've been looking at, but haven't really pulled the trigger on, although some people have, but I haven't yet. But this is natural gas, and it's been getting pummeled. Now, excuse me. I just wanted to pull up set up this chart, see how this. And I just want to get some of the stuff out of the way. Whoops. Okay, good. Okay, now look at how this is natural gas, the commodity. And I can see now. You can see how important on a long-term basis. Look how it got a little bit below the 200-day moving average, but that was great support. It finally broke below it. It fell out of bed. Old support becomes new resistance. Now it gets a little bit above it, but then can't seem to get above it. Breaks down hard. But look at this RSI chart, relative strength index. Remember talking about that? It's not quite as sold as it was, oversold as it was in October, but it's getting there, getting very close. There's another thing that we look at, and it's called the Bollinger Bands. And look how this thing is getting. It's hard to see here, but it's still not quite for me where I want to get. It's probably something I was thinking about buying it today, but it just wasn't getting there enough. But this was called the Bollinger Bands. See, when the thing gets below this green line, that means it's getting more than 2 standard deviations below its 20-day moving average. And see how it rallied there? But see, it can ride that line for a while, like it's been doing lately. But until it gets below that line, it's not quite there yet. Also, in sentiment, the number of bullish, bullishness within the trading community, futures traders, it's down to 14% bulls. Not many bulls left. I'm hoping this thing can get down below 10. If it gets down below 10, it's going to provide an unbelievable buying opportunity. And what are we going to look at? We're going to look at the ETF, the leveraged ETF, BOI. Oops. Here it is. BOIL, that's the leveraged ETF. Bang. So we'll look at that one. See how that's getting oversold. See how oversold that one is? That thing bounces. See these bounces? Okay, it doesn't look like much of a bounce there, but guess what? What did I do with it here? That is a, shoot. Oh, there it is. I'm sorry. There we go. See this little bounce it had in December? Oh, it didn't bounce much. That's 64%. You know how much your options are going up? If this thing goes up 64%, your options are going up several 100%. At some point, this is starting to get really oversold. See how it's almost as oversold as it was there? More oversold than it was there. Look what it did. We're going to be looking at that. We can also look at the KOLD, which is the same thing. It's just not as liquid. It's also another ETF. But then you can look at Chesapeake. What is it? CHK. I'm sorry. CHK. Chesapeake Corp, which is a very heavily involved. It's an energy company overall, but they're heavily involved in natural gas. See how this stock has been getting hit lately? It's getting oversold, not crazy, but look at the last 2 days. It's kind of bottomed out. Even 3 days, it's bottomed out. It looks like it's forming a little bit of a base here. And see how it broke its 50-day moving, its 200-day moving average, that purple line. That's not good, but it's forming a base and it's getting oversold. So this one's getting ready to bounce. We'll be looking at that stock. Again, this is on a short-term basis, but I like the energy and I like natural gas longer term, intermediate to long term. But I've been keeping away from it because we haven't quite got to that extreme. And that's again, well, I might miss the opportunity by holding off, but the momentum has been so bad for natural gas because things have been so warm in the East Coast, but more importantly in Europe. They get cold, this thing's going to bounce back in a big way. And there was some things about ceasefire in Russia for their Christmas. I don't think that's going to last very long. It's another reason why the natural gas should bounce back. So that's another area that I'm looking at right now. The gold is my other one. It's gold. This is the commodity gold. Boom. Now, all of a sudden, a lot of people are talking about it, and they're saying, well, I hate to say it, but I've been talking about it for almost 2 months. Well, certainly since November. And let's look at the technical backdrop. It's funny how these people all claim, I've seen these people on TV and they're like, gold, yeah, I don't care. And then suddenly they love it. And I've been pushing it for 2 months, or almost 2 months anyway. But look at this situation here. I'm going to get rid of these moving averages. Okay. Oh, shoot. Okay, good. Okay. There we go. But look at this. Okay. Now, it has broken above its trend line going back to last March. Everybody said, what happened to gold? It's supposed to be a hedge against inflation. Well, it didn't work. And I stayed away from it. But then in here, I started a nice little double bottom. It was forming a very nice base, a very, very nice base. And I said, look for this thing. If it can break above its trend line, that's going to be really bullish. Well, sure enough, as soon as it broke above that trend line, it took off. Now it's been after making a series of lower highs and lower lows, nothing worse in technical analysis than lower highs and lower lows. But this one didn't make a lower low. This one didn't make a lower low. They made equal lows, kind of a triple bottom, nice base, new high. And ever since then, the trend is completely reversed. Now we're making higher lows and higher highs. They're all kind of mini ones, but they're good things. Now, gold is getting overbought on a near-term basis. And in fact, we were talking about it on our Tuesday call 2 days ago. I said, don't be chasing it here. I don't want to chase this here. It's got to pull back, and sure enough, it was trading up at the 1860, and sure enough, it's come back down. Now it's at 1830 because it saw that it was getting ahead of itself. I want to see it. I want to see it get down towards 1800. Well, I don't think it'll get all the way down there, but somewhere below 1820, we'll be looking at that. And if it gets in that area, then we'll be adding to it. Now we own several gold and silver stocks that we've bought in the chat room as well. We have not bought the options in that one, but we will at some point. And once this thing really gets going, but I know you say, well, gold didn't work as a hedge hedge against inflation last year. I'm like, I know, but the charts are telling us that for whatever reason, maybe it's a flight to safety. Maybe people are worried about the war getting bigger in Ukraine. Maybe they're worried about China invading Taiwan. Maybe they're worrying about the dollar losing its, it's starting to get cheap. I'm sorry, it's starting to roll over here. It's going to lose some of its luster as the key currency in the world and the reserve currency. I'm sorry, and so there's a number of reasons to think gold's going higher. And when gold moves up, the gold miners go up. Usually they're leveraged about 3 to 1, 2 to 3 to 1. They're going to move up quicker and faster. And we're in some of those names. So that's another area that I want to look at. The key is going to be what's going to happen with the dollar. And everybody's saying the dollar is going to. Well, it's so weird how people keep kind of going back and forth. But a lot of people, let me just pull it up here. This is the DXY dollar index. And let's go down to currency. Boom. See now how, it had this straight up line and, going straight, it'd been going up all year last year. Now, now it's sold off and see how ridiculously overbought it got. But now it's kind of leveling off. What's going to do next? Is it a nice little goose here? Is it going to crack higher? I don't know. We'll have to see. A lot of people are expecting it to go higher. They're thinking that if the market starts to get hit, which I think, by the way, we can go into this. I think the stock market's going. I think it probably did below 3,000. I really do. But I definitely think it's heading down towards the 30. And I've been saying this for a long time. A lot of people, it's like for me, it's like. you work at a small firm and, they say, well, they give credit to the guys at Morgan Stanley, or whatever, but I've been saying the stuff since before them. And 3,000 to 3,200 is, I think we'll be lucky to hold that because earnings are going to come down. And I've been saying this since this time, well, certainly since the end of the first quarter last year. I was calling for a recession, calling for earnings to come down dramatically, and I believe that's going to happen. But look at this happens with the dollar, is that people think that we'll have a flight to safety and the dollar will go higher. What happens if they do the flight to safety goes into gold this time? It could happen. But the other thing here, now if you guys are familiar with let me just pull it here. So the golden cross or a death cross. And what it is when the 50-day moving average crosses above or below the 200-day moving average. Let's go back here. 2005. Okay. Now you can't see, okay, but see when we had the negative cross here, I probably went back too far. Let's go back 10 years. It's harder for you guys to see, but here we go. You can see a little bit better. See the negative cross here? It didn't happen. It doesn't happen at the top. All right. It happened here. And see how much lower the dollar went right after that? See here, negative cross. The dollar went downward to sideways for a while. It certainly didn't rally. Here, it wasn't as good an indicator, okay? But see over here, see how much further it went down? If this thing crosses, okay, if we get this negative cross again, just like we did back here in 2020, it's not going to be good for the dollar. Dollar goes down, gold is going to rally, and so is oil. So that's another reason why I'm thinking about the dollar doing why I like the energy stocks. If there's one thing, it's funny. A year ago, I was completely in minority. There were very, very few people who was as bearish as I was. I mean, I was saying deep recession, deep correction, significant slowdown in the economy. As soon as Russia moved into Ukraine, I said it's going to be worse than a deep correction. It's going to be a bear market, and it's going to be worse than a slowdown in the economy. It's going to be a recession. Well, we definitely got the bear market. I think we're going to get the recession. Now it's obviously more consensus. A lot more people saying I get a little nervous when I'm in the consensus, but I just think in this case. It is going to follow through because you can't unwind the amount of leverage. We go from these massive levels of steroids to go off steroids. You can't go back to steroid strength without being back on the steroids. And we're not going back to zero interest rates. We're not going back to QE. If we do, I'll change my mind. If we don't, we're not going back to that same kind of strength. It's just not going to happen. And so, we had it in the late 1990s. We had it the last couple of years, 2000, 2021. When you don't have it, you can't have that kind of strength. You just can't. You can't have those crazy valuations. So here we go. Look for this thing. But one thing that is not the consensus is people looking for a lower dollar. I'm not saying there's a huge consensus looking for a bullish on the dollar. And to be honest with you, it is looking pretty good right now. The dollar's starting to turn up. It's trying to go back up. Let's see what happens. So I'm not pounding the table on this one yet, on the dollar. I am bullish on gold, but I do think we might get a little bit further bounce in the dollar. Okay, that'll cause gold to come down because there's an inverse correlation between the dollar and most currencies. The dollar and most commodities, and inverse relation. And so if the dollar rallies a little bit more, gold will come back down a little bit. That I think will be another great entry point. We've already bought some, and we're going to go back into some of these stocks sometime in the next couple of weeks. For the next move higher, but we'll be watching this very, very closely. But again, a lot of these different things that we're trying to help people understand, rather than just saying, "Hey, a little birdie tells me that AMC is about to go higher," because there's going to be a short squeeze. I'd rather have real reasons, fundamentally, technically, position-wise, et cetera, et cetera. And so that's what we're really working at. But we got about 15 minutes left, so maybe Rodrigo,
let's do. Yeah, so look. We got 15 minutes left in here. After the 15 minutes, I'm going to do a quick walkthrough of the live room where you do all the magic and where it all happens. Let's do something that I like to call rapid fire. So we're going to get a couple tickers from the chat. So everybody start riling them up. It's one per person. And we're going to pick a few of them. After we're done with this, Matt will give closing remarks. We're going to show you guys the live room. Try to not include any penny stocks or any of these, shitty coins. We do want to keep it to the stocks that, for the most part, we can trade with options. All right, we got a nice one here. Someone has been asking about snow. Matt, you're familiar with this. It's a software company. They have a lot of Fortune 500 customers. What about snow and what about that sector, tech sector to be specific?
Okay, what's the symbol on it? I can't.
SNOW, snow, the white
Oh,
snow.
snow. Okay, I just you were coming in. I'm sorry, I just couldn't hear you clearly. It was my fault. Okay. Okay. Well, let's talk about snow, and then I'll go to the tech to the tech sector. Now, okay, here we are. It's this is what you want to think about: short term and intermediate term and long term. So we're trying to give this answer to you in a couple of different ways. Let's get again. I just want to get rid of some of these lines so you can see a little bit better. Maybe we'll go back a little bit further. Okay, great. So here we go. Is that, obviously had this big sell-off for the year, then a nice summer rally. Now it's been going nothing but here. Same thing. Lower high, lower low, lower high, lower low, lower high, lower low, lower low. Well, a couple of times it came slightly higher right now, but yeah, lower high. And we're making another lower low. It's getting oversold, but not dramatically so. So you want to see this thing get a little, probably go down, get a little bit more washed out, and then you can nibble on it. And maybe even look at some call out. Let me zoom this in a little bit so we're not, let's see it a little bit better. Boom, there we go. I'll do it again so you can do it. There we go. Okay, now, so this is what you want to do. Now, remember, if you buy this thing, if you just buy the stock, forget about the options, you buy the stock when it gets oversold and it starts to run, what are you going to do when it gets to the 200-day moving average? Look how it's gotten very close to it each time it fails. So what you're going to do is you're going to take profits. You're going to hold on to a little bit, though. You're going to hold on to some of it. And then if it does break above that 200-day moving average, you're going to buy that stock back so fast. So it won't matter. It's like, okay, I bought it down here. Let's say it's down to about 115 or so. It gets oversold. It runs back up. It gets up to its 200-day moving average up near 160. Okay, so I sell a little bit. Well, geez, if I sell it at 165 and I have to buy it back at 166, okay, you'll miss a little bit, but that's okay because you're looking for that confirmation. You've already made a big profit in it. Who cares if you miss $1? And if the thing goes to 200, it goes to 250. So you missed $1 in the middle. You bought a bunch, you sold it, and you bought it back here, and it kept going. Who cares? It's okay. My point is that you want to be able to take profits here, and then once it starts to break down, then you get completely out of it. However, when it gets back up to that 200-day moving average, right? You still hold on to a little bit. If it breaks above, you buy the rest of it back to a full position and you let it run, because all those algorithms are telling us that the 200-day moving average is big resistance, and once it breaks that resistance, they're gonna switch from being big sellers to big buyers. There's gonna be a short squeeze. This thing is gonna run easily to 200. It was at 250, it could take off again. So this is the strategy right now. Hold off. I think it's got a little bit more to go before it becomes oversold, like it did back in May. And see, that one was that only lasted for a couple of days, that rally. You can see, and let's look at another one. Let's just look at the weekly. Sorry, here I had the daily there. Let's go to the weekly. Yeah, see how the weekly chart, even when the weekly chart gets oversold, here's another reason not to like this stock and not to buy it yet. This is what's called an outside down week. You have to see where it closes tomorrow. But if it closes below, I don't want to get too much into the weeds, but if it closes below 133.50, which it almost certainly is going to do, unless we get a really good rally tomorrow, that's going to tell you that its downside trend is still intact. So you want to let the stock drop further, let the weekly RSI get oversold, but then you buy the stock, and then again you look to add to it if it gets above its 200-day moving average. So short term, hold off, buy it when it gets more oversold. Intermediate term, when it gets to its 200-day moving average, take some profits, and then buy it right back if it breaks out, and then it just takes off. I'm telling you that again, not only that, but it would break above its, and not only would it go above its 200-day moving average, but it would break above its trend line, going back to its all-time high, which right now, again, you'd have to go like here. Oops. Okay. But that's the weekly chart. I'm moving around. But anyway, that's why I look at it stuff. So hopefully that gives you a good idea what to do on both a short-term and intermediate-term basis.
Yeah, and I want to give a shout out here to Thunder Be Do, yeah, our most recent family member. Let's welcome him. Let's go. Wait, no, that's the wrong one. That's the
Thanks
wrong.
for joining. Good luck. And tomorrow will be a very, very interesting day. It'll be a good day to be joining because we got that employment number. We'll be out before the opening at 8:30, the 8:30 Eastern time. And of course, the market opens at 9:30. So we could see some big moves between 8:30 and 9:30 tomorrow. And then obviously some really big moves afterwards. We'll just have to see what happens, see how that number goes. I still think the earnings season is going to be more important than the data, the economic data numbers. Lately, the employment number, the CPI, those inflation numbers have been the most important. I think earnings are going to be the most important this time around. They start a week from tomorrow.
Really? So let me ask you something, man. I don't know what the numbers are, but every time there's an election, a presidential election, the markets tend to do, I don't know, you see this number, this number out there, right? That every presidential election year, the markets tend to do well. Is that true? Is it not true? Do you think
that's another thing.
of...
There's another thing where these people, I mean, these people, these perma bulls, and they're paid to be bullish, and they're on these financial networks, and that's what they say. I mean, they don't say on the financial networks, they do it in their writings and stuff, and that's fine. Believe me, the people that work at the financial networks are great. They grill them and they ask them some tough questions. But there were people out saying every single year when we have a midterm election, the stock market rallies in December, and not only it rallies from election day until the end of the year, in November and December, and in December. And one guy said every year since World War II. And I sat there and said, how can that guy say that? That's just flat out wrong. In fact, the most recent midterm election was 2018. The market got crushed in November and especially in December of that year. And so what I said, well, all these other people were saying, oh, it's seasonally a good year for the market. I was saying, you have to compare apples to apples. Apples to apples are in a bear market, whether it's an election year or whatever, bear market, December, the market does poorly. That's why we were able to do some really nice trades in December this year at the very end of the year and finish strong while other people were getting their heads handed to them at the end of the year because I looked at what was really the data, not the easy data. When you get what that guy was given was just trivia. It was trivia. He didn't look into the data in any kind of, well, first of all, the guy who said it happened every time was just wrong. The people who said that it usually happens, they were correct, but they didn't look at the times when it didn't work. And I went back and looked at it. So why didn't it work these times? It didn't happen very often. Oh, geez, they were all bear markets. What are we in now? Bear market. Hello, McFly, hello. And we were able to work out real well with that. So again, it's something I picked up over the years, and I think it helps newer traders immensely, and it's certainly helped me over the years.
Right. And look, I want to thank you, Matt, for being here. Matt Maley is a chief market strategist at Miller Tabak. Prior to that, director of trading at Merrill Lynch, where he managed the two biggest funds in the world, Mutual and Hedge, BlackRock and Fidelity. Prior to that, trader at Solomon Brothers, which was the most important trading desk in all of Wall Street during the 70s and 80s. So, Matt, you have a great...
In the 90s, too. I wasn't there in the 70s. I'm not that old.
Well, I mean, yeah, you've been trading for a while, man. So, I mean, you've been trading longer than most of us here have been alive. So that's quite, it's quite cool. W. Concall, excellent seminar. All right. Yeah, folks, it's been a great one. And if you do want to trade more with Matt, which I'm pretty sure all you guys want to, we will put the link to join there in the chat. Matt, I want to thank you for your time. I'm going to stick around for like 5-10 minutes. Any closing remarks on your end for all the viewers, new traders, people that are trying to learn?
Just to reiterate what I said at the beginning is that whatever you're doing, don't do it alone. It's not, I mean, and it's if you don't use our chat room, make sure you're talking to people who you respect and who know what they're doing, because it's even if you don't do what they suggest, it's always good to have another opinion to bounce things off of, and that's just one of the things that we try to do. And it's like I said earlier, if the biggest and best hedge funds in the world don't trade alone, why would you? And this is a great way to do it. So anyway, thanks a lot. Good luck this year with everything. And for those who joined up and those who are going to be joining up, welcome. And we'll talk to you in the morning. And it's going to be a very interesting day next week. But I've been telling you, tomorrow should be a pretty big day. You never know. It could be a boring day. but it rarely is unemployment day. But next week we got CPI, then earnings season starts. I'm telling you, the next couple of weeks we've had some nice trades the last few weeks, but it's been relatively quiet. Things are going to pick up in a big way going forward. Some great opportunities. So good luck, everybody. Thanks, Rodrigo. We'll see you in the chat room, and we'll talk to you real soon.
All right. Yeah, I'm muted. My bad. So this chat room, the blue chat room where you're seeing this, for all the people that did join or do want to join, make sure you know how to use this, right? When you come in here, there's two channels. The inner circle chat, that's where everybody's talking. James Donahue, I signed him up like a year ago. Cool guy. Last mile. Where's the UPS driver? We got a UPS driver here. Randy. Felicia, she's a realtor. Yeah, there's a lot of familiar faces there. Ben, I'm new to this. What's the best? You definitely got to join the chat room. That's definitely my members, including Matt Maley. Back and forth questions, feedback on your trades, feedback on your strategies, mentorship guidance, trade management, entries and exits. All this stuff is here. Plus the community, what they're using, talking about. Below, there's another chat. Matt's important messages. This is where you get the juice. Entries, exits, buying calls. You get these on push notifications. So if you have a phone, download the Benzinga app and go in with your credentials, and you're going to get automatic push notifications every time he puts out a trade. You will get it on your phone. If you aren't able to have a laptop or a phone open like this, like I have it, it's very simple. Let's see. So if you see, I mean, it's pretty straightforward. These are not butterflies, credit put spreads, covered calls. These are basic calls and puts. The link is not working. Siri, let me send you the link again. I just opened it right now. Give me a quick moment. Oh, Darwin was able to join, so I think the link works. Let me open it here. I'm going to open the link, and as a matter of fact, I'm going to show it to you. And that way I can walk you through it, all right? Mailing Curd. Okay, so I just opened the checkout, Siri, so you can watch it. As you can see, you put in the email that you want to sign up with here. So Ninja Trader 123, whatever that you do want to use, and then you can pick stock picks. Annual, it's $19.97. If you do want the lifetime, it's $4,000. It's a one-time payment, and then you put your card info, you make the order, and that's it. Boom, you're in. So it's pretty straightforward. If you do have questions on here, this is my direct. This does expire at midnight. I do want to let you know, Siri, if you have questions on this, make sure to email me and I'll hook you up. It's all good. But yeah, just to show you, okay, this is a live room. This is how it works. You're going to have a Tuesday call. That Tuesday call, I'm going to show you where it is. Inner circle session. Let me show you how it works. All right, so you can see this one is video. Matt Maley is all suited up there. Obviously, he probably came in from an interview from CNBC or Bloomberg. wherever he's all out there, you know that. So I'm going to show you guys this really quick, just so that you guys can get a sense of how the Tuesday sessions go. They're from 11:30 to 12:30 trade updates. Let me show you a little bit of this so that you can get a sense of how the meetings are. 8:30 to 5 p.m. Eastern. Let me go ahead. Trading for tomorrow. Believe me, I had to use my mom's PayPal's credit, and I'm over 50. All right. So let's watch the video really quick. All right.
Okay. Hopefully this is on. Had some issues. I don't know what. Can people see me and hear me? So if you could just let me know. Oversold. What 100 and well, what? Thought I saw the 107. So it's even break below those. It's already it's trying. It's below those lows from last week. Trying to hold. Looks like it wants to go to 100. So that's the big thing there. But the Apple on the overall market, the thing in Apple is the one that concerns me more because it's a much bigger weighting and it's such an important stock to. So I'm going to do that. I meant to do this. See, it's really not, see how it gets below its Bollinger Bands chart before it bounces back most times? It hasn't done that yet. So it looks like it wants to go lower. The other thing I just want to address this is just talking about today. The other thing I want to address on a more intermediate term basis, you're going to hear a bunch of stuff, bespoke, what's called bespoke, they got some good stuff, but most of it's trivia. And they'll come out and say, oh, one out of the 3 days, first 3 days, if the first 3 days are bullish or bearish, it's a bunch of bull. Okay, but yes, it does, and of course they always talk about the first month. The first month, I mean, last year it did work. The first month was down, and the year was horrible. But do you think anybody sits there and says in May or March or September sits there and says, hey, I know the market's doing this, but it was down and it was up in January. Therefore, it's ridiculous. So disregard any of that crap. That stuff about what happened. It's trivia. I understand why the press uses it because it's trivia and it's what they use just to talk about things. But nobody uses it in serious analysis, nor does the press. And if we're going to look at, as everybody said, you got the market always rallies. It's a seasonal thing. The market always rallies right after a midterm election. Well, that didn't work at all last year. That stuff just disregard that. It's like I said, it's trivia. That doesn't mean that we obviously we want to pay attention to what's going on in the markets, but we're not going to interject that or see what's going on right now, and we can say, hey, that means something about the next couple of weeks. Doesn't mean anything about the rest of the year. It's just a bunch of trivia, like I said. Anyway, but there's a couple of things that we do want to talk about. First of all, the XLY. This is, for those who get the Maley report, saw this, I wrote about this morning. This whole thing about consumer confidence, this is a problem. Obviously, the consumer discretionary ETF is very important for the consumer. Not to be more, but you see how this made a key lower low. Nobody's talking about this. Why? I'll never know. But the key, here we go, bang. See how we made we made a low in June, a low in October. We got a new lower low, but very only slight one in November. But this is now confirming we've got a material lower low. Okay, what does that mean? It means that all that stuff I've been talking about for a while now. Everybody was saying all summer long, don't worry about the consumer. The consumer's still strong. Well, I was saying the only reason why the consumer was still strong was because of the because they were going into their savings. The savings rate had gotten back and is back to 2008 levels. Credit card debt making all-time lows. And you can even, if you do here, I could draw the line like this. Hold on a second. Bang. Draw the line like this, the red line there, and we got left shoulder, left shoulder, head, right shoulder, breaking below that as well. So we got a head and shoulders. No matter how you look at it, this is telling you this consumer is not going to be good. Like I said, left shoulder, head, right shoulder, descending neckline. We're below that. We made a key lower low. I mean, nobody really talking about this. And without
all right, folks,
a consumer and a consumer.
I just wanted to show you a little bit of how that meeting is with Matt Maley, the chief market strategist. Typically, if you would like to talk to a chief market strategist, you probably walk into an equity firm. They would put you in with a junior sales associate. You give him all your money and you pay him a percentage and you never see him again, right? You just get your statements every month. In this case, you're talking to the top person there, the analyst, Matt Maley. You have those meetings and you get his trade feedback, all that sort of stuff. So I just wanted to show you how the session is. Back to the chat room, guys. If you have any questions, send an email. The contact is there. We're going to wrap it up here for the day. So thanks a lot for being here. It's been like 2 hours of intense market talk. Make sure to, go through this, right? Make sure that if you do want to join a community, join a smart community. Don't join these public pump and dump, cheap Discord chats that are all out there. Find a legitimate community, a legitimate company like Benzinga that really gives you that, that guarantee, right? Deborah, good to see you. Have a great night too. I hope you're recovering well from what's going on. And big shout out to all you guys. Let's go ahead and wrap it up here. Everybody, thanks for coming up. Big air horn. Let's go. All right, folks, that does it. Have a great Thursday. Stay safe. Happy trading. Make sure to trade with a plan. Don't be irresponsible. Don't be a gambler, please. And if you do want to join the chat room, you already know where to contact. Have a great day, folks, and we will see you in the chat room tomorrow.